Very much like last quarter, this quarter also our operating performance is quite strong, driven by certain priorities we chose to ensure the businesses that are relatively higher margin keep growing, ensure that our deposit franchise continues to get stronger and granular both at the same time, and of course keep a tight watch and vigil on the whole area of slippages and more importantly strengthen our balance sheet. On all counts, I think we've made meaningful progress through the 3 quarters of this financial year, and particularly the quarter that is in focus, which is Qtr3 FY21. Our operating profit grew quite well at about 29 odd %. Second highest ever. Last quarter was the highest. We did have a one-off gain of a particular recovery on a written-off account. Back that, this would probably be a more structured, organized operational profit growth quarter. And that helped us both increase our coverage ratio and set aside higher provisions for what could potentially be higher requirement in passage of time should the environment continue to be a little less lackluster. But that said, growth in areas that we focus on has been strong and is showing good signs of revival. December 20 in many of our businesses indexed to Jan 20 saw performance level between 100 and 120%, whether it's home loan, auto loans, business banking, commercial banking, and of course gold loan was spectacular. You would have certainly noticed our gold loan growth continues to be staggering, grew 67% Y on Y, and as did our deposit franchise. So the most happy and noteworthy factor is our franchise is coming to work every day despite the pandemic, and that's helping us grow our low-cost deposits as much as our gold loan business. And business banking, which is heavily synchronized with the branches, has also started seeing good traction. Retail started picking up, so did digital. Digital was a very special quarter because not only did we achieve our digital, we made progress on our digital journey, we made significant internal strides. We are the first and only bank with the face recognition for employees to log into the core banking system. So we've taken digital to a level where it becomes more practical for day-to-day conduct of the bank. So with that, let me just, the numbers are there for everybody to see. We believe that we've increased our coverage quite materially. We believe that our provisions are now tracking to what we think may be the best ever. Our slippages seem quite under control, or rather quite on guidance, what we had guided for in the first 2-3 quarters of this year. Happily, the restructuring requirements are 1/2 or even less of what we thought could potentially be restructuring when we went into the Q2 results. So you may have observed we've put out virtually every number possible in public domain through the investor deck and through our disclosures, and the team will be more than happy to answer questions. In specific to Q3, our overall slippages for Q2 and Q3 was about 1,068 crores, and the mix is there in the slides. Our GNPA and NNPA for the quarter ending was flatteringly good at 2.7 and 0.6, but we believe that if you put the notional NPA, then the numbers go up to 3.38 and 1.14, which may, the truth when it happens, may be somewhere midway. I do think it will get as adverse because as collection efforts strengthen and customers realize they're actually going to be tagged NPA, I think behavior will change and improve. Collection efficiency continues to be strong. Restructuring demands for all businesses except the residual MSME, which has time till March, is likely to trickle in. We've done about 1,067 crores of restructuring so far. I do think maybe for the next, that is Q4, the number can go up by another 300-400 crores. So that's where we are. We have ended Q3 quite well. We have navigated the storm better than our imagination or the worst belief. The team has come together extremely well, held out to this challenge. Coverage has gone up. Low-cost deposit progress is continuing. NIMs have been stronger than ever before. And we believe that this momentum should continue. The areas we've chosen to grow are doing well. Well before the pandemic, a few days before the pandemic, we addressed many of you and shared our vision around how we will expand margins, how we will take the momentum to 55% retail, 45% wholesale. This quarter is testament to that. It's at 56-44 retail wholesale. So I think we are tracking along those lines, and we believe we will keep pushing that. 54-46, and we believe that in the quarters ahead, many of our sort of desired outcomes would play through. So with that, let me just pause. All our senior team members are on this call. As always, we are happy to answer questions and clarify, but we've tried to capture almost everything that we would want to say in the investor deck, and I do hope all of you have had a chance to see it and then ask us. Ashutosh, Shalini, Harsh, Anand, Babu, Nilufar, Kapil, a few of the seniors who are on the call, but a few more can be there to answer questions. So thank you very much, and once again, thanks for all your support. I'll have our team members stand in for questions. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Arav Sangai from VT Capital. Please go ahead.
Hello.
Yeah, go ahead, please.
Yeah, hi sir. Thank you for the opportunity and congrats on a good set of numbers. So I had two questions. My first question is related to provisioning. So we have had good 3-4 quarters of high provisioning, and as far as I can see, there's a 1,500 crore of restructuring that we are expecting. So wanted to understand what is the credit cost outlook for the next year, as if we take the 566 crore extra provisioning we have on our balance sheet, how this pandemic has shown that all of us will try to maintain some extra provision on balance sheet. So do you foresee maintaining some extra provisions also going ahead, and the guidance on credit cost? And my second question is on growth of the book. So we have been growing the gold portfolio very well. So just wanted to understand that since there is a lot of competition and a lot of tier 1 private banks are also coming in growing the gold portfolio, what are the other areas that we are looking to grow our book in the next year? Thank you.
I think our portfolio growth will be fairly widespread. Gold loan certainly stands out because it's been spectacular the last 2-3 quarters. The environment, gold is inversely proportional to other developments in the market. As the market stabilizes and credit growth gets stimulated across other categories, we will see them all growing. We've already seen business banking growing 13%, commercial banking growing about 12-13%, non-gold retail growing closer to double digit, and this will certainly pick up. The only area that we saw lower or degrowth was in corporate, but that was partly conscious because we didn't see much point in doing business which are not giving us the returns. That said, the corporate banking has done a great job on fee income origination, which you would have seen some success on that count. We think our business mix will continue to be widespread, and we have a couple of new launches coming up. Our credit card launch is due in March, April this calendar year. And the businesses that we have started and put on a little softer gear were commercial vehicle and microfinance. As the environment picks up, these will start kicking in. So we think we have a full spread, and all of that will fire up. And as the environment picks up, gold may not grow at 60, it may grow at 25-30, which is a very welcome place for us. So business mix and growth in credit, we are quite confident of. Provisioning, we've been conservative. We've built a very strong provision buffer. We have also created a standard asset provision that is regulators have allowed. And we will see how Q4 ends, what the regulatory dispensation is going to come, because there's a good chance that all of them have to be used. We don't know what the outcomes of RBI's decisions is going to be. We will decide that as we go, but our short point is we will keep our credit costs, as we've always done, between 65 to 80 basis points, depending on the year that's gone by, the environment. This may be a little higher in the immediate period, given how the sort of bounce back of the economy. But I think it's something that will not distort our outcomes because we are quite well thought through in how we will use these provisions, subject to all regulatory allowing. So yeah, we are in a good place on that count.
All right, sir. That's it from my end, and thank you so much.
Thank you. The next question is from the line of Pritesh Bam from Prabhudas Lilladher. Please go ahead.
Hi, sir. Good evening. Just wanted to check from Q2 to Q3, what would have changed for some of the underlying businesses where you have lent in terms of, is there a growth pickup for the businesses? Liquidity was an issue and now it's been quite good. So what gives confidence that restructuring has been lower? What has been the challenges, and what are now the things which are eased for them? And if there will be direct NPAs later on, you may not be restructuring, say, 2-3 quarters down the line. So any views on that side, sir?
I think this whole, how restructuring will play out is anybody's guess. But the fact that restructuring has been done based on certain credit filters, which essentially means the account should have been standard up to the break of pandemic, and then we have looked at the potential for repayment, and it's almost like a re-underwriting of the credit. If you believe that we have re-underwritten reasonably well, just like we have underwritten the original book, then the loss rate should not be dramatically different if the environment holds. That said, these are accounts that have had some stress because of the pandemic, so we have factored in maybe a 10%, 15% worsening than our normal run rate. So I don't see material deterioration. That said, we have to just keep a close watch on how the environment shapes up. All of us are betting on the fact economically the worst is over, and from here on there will be a meaningful recovery. All indicators suggest it should. And by design, our mix is, we are not in very high-risk businesses. And even more by design, the businesses that we are now showing highest restructuring is in retail. And even more in that, it's retail home loans. It's not an unsecured business. So we think we are reasonably well positioned. These are customers who probably are sort of resetting their own financial models and ensuring that they don't go belly up. So I'm not being overly optimistic, but certainly nothing to panic at this juncture.
Sir, actually just wanted to also check, is it that because we have seen lower outcome in the SME side or the other businesses other than retail side, so anything changed there for your customer base in terms of what was the issue and now what is the...
I have never signaled any...
picked up?
I have never signaled, or Federal has never signaled any risks on that differently from what our belief is. It's the assumptions made by the market, and I'm glad our assumptions are holding out. We feel... we always felt that this segment, we've been quite watchful and our book is held out, and it seems to bear out. It's not like artificially deflated. This is the demand and this is the outcome. And in these segments, I think the GECL is helping. Therefore, these are people who have revival potential is higher. If the economy doesn't deteriorate from here and there are good stimulants, then the comeback of all these should be quite okay. And if the upstream corporates are doing well, these will before long get lubricated fast.
Sure, sir. Thank you. Second question was on capital side. Any plans to raise capital in near term? Because our CET is still, 12-13% type, if I see that correct. So any plans to raise capital?
No, I've maintained in all my calls for almost a year that we will not do anything in a hurry. We will certainly keep a close watch. If at all, it will be after the second half of this calendar year. We will keep a close watch. Our capital adequacy is sufficient at this juncture. Our business model doesn't consume capital at a rapid pace. We are consuming 20-30 basis points, and we have enough headroom. So that said, we must be mindful, but we appreciate capital is expensive. Capital is something that we have to be very watchful of. So I don't see us doing it in the immediate future, but that said, we will keep a close watch and see how it plays out in second half of calendar 21.
Thank you, sir, for answering all the questions. Good day.
Thank you.
Thank you. The next question is from the line of Pranav Gupta from Aditya Birla Sun Life Insurance. Please go ahead.
Hello.
Yep.
Yeah, hi, sir. Good evening. Just a couple of questions. So, firstly, on the restructuring side, so your retail restructuring seems to be relatively high, and you sort of alluded to the fact that it's largely coming from the mortgage piece, which is obviously a large part of your book. So, could you give a sense on what sort of reasons are leading to this restructuring being so high in the home loan and mortgage book, especially given that this market has been relatively buoyant?
No, I don't know. I don't know against what comparison you would say it's higher or lower. It's against assumptions made by people, right? Ours is real. So you have to now start re-benchmarking your assumptions against the reality. This is what it is. I mean, we are not fabricating a number and putting it out. This is how customers have behaved, and this is what it is. So it is. I guess it's a function of customers wanting to be maybe reduce the monthly payout and seek this as an opportunity because they've been standard up to February end. So they want to keep a lower EMI and they want to benefit from this and ensure that they are on the right side of both credit as also their own their own cash flows. I don't see anything standing out in this other than the fact that the non-resident portfolio of this restructuring is about 30%, which means if 100 rupees is the retail restructuring, but 25-30% will be the non-resident, which again explains the fact that the non-resident, if they are seeing lower income flows, they may want to keep their cash flow payouts also lower. So I think that's the only thing I can attribute this to.
Okay. And is the restructuring number from the LAP book a larger number, or is it more from the housing side?
I would say it's about 55% home loan and about 40-45% LAP.
Okay. The second question is to Harsh, if we can give some more sense on the corporate side, because we've seen a dip in the growth. Is it because of the pricing that is there in the market? Is it because of what sort of tenures that banks are willing to lend? If you can give some sense on that part in the corporate side.
Yeah, hi, Harsh here. Am I audible?
Yeah. Right.
Yeah. On the corporate side, we've been a conscious call that we would avoid assets where the pricing has become, and the pricing in the market in many places has become a little, I would say, out of whack, doesn't justify it. So we have stayed away from certain assets which otherwise would have made sense. That's one conscious decision. The second part was that the working capital cycles have, for many corporates, crunched. So this was largely on account of this. What I can tell you is that there's a lot of new-to-bank acquisitions which has been made, which has been better this year as compared to last year as well in the large corporate space. So we'll continue doing that part and doing meaningful assets rather than doing assets just for the sake of top line. The fee income growth has been actually higher than the last year for the current year, in spite of an asset being tepid. Secondly, even total income and CASA for the corporate book has actually shown a growth. So what we are looking at is a deeper penetration and more bang for the buck. But okay. I do see asset growth, the slightly returning back to the market, levels getting better. It's too early to say, but we do expect Q4 the rates to normalize a little bit and excess liquidity being sucked out. And a great offtake also improving. So when I see the outlook, I see the outlook better than what it was.
Okay, sure. And lastly, just a data keeping question. Could you give out the numbers for the disbursements done under ECLGS 1.0 and 2.0?
About 2,600 crores total, grand total.
Okay. And large part would be 1.0, right?
Yes.
And the second one is still going on. You will see something in Q4 as well.
Okay, sure. Thank you so much. That will be all from my side.
Thank you.
Thank you. The next question is from the line of Rakesh Kumar from Systematic Shares. Please go ahead.
Yeah, hi. Good morning. Hi. Can you hear me? Good afternoon, sir.
Yeah, please go ahead.
So the first question is that on the pro forma NPA, we have a provision coverage of around 66% as given in the deck. So what amount of the provision we would like to keep on a sustainable basis on the gross NPA number? That is the first question, sir.
Yeah, I think we've mentioned in last call and this also, between 65 and 70% is our steady state non-technical write-off PCR that we will build till we see the markets materially improve. If you remember, we were in the 40-45% pre-technical write-off slip coverage ratio. And as the environment started getting stressed out, we added almost 20%. And I think somewhere in the 65 would be a good place, considering our book is significantly secured. And we think so far at least LGDs have been sub 40.
Okay. And on the restructuring book, sir, how much provision we would like to keep? 1,600 crore number what we have given. So how much provision we would like to hold on this number?
We'll see how the quarter shapes up in Q4, but I would think between the bare minimum we would keep is at least 15-20% of that.
Okay. So thirdly, just a last question. On the performance slippage also, in the retail segment, we have relatively higher number. So again, what is the characteristics of this 314 crore number in the retail bucket?
This is 3/4 slippages, right? Because if you take the Q1, Q2, Q3, there were no slippages. It's a bunched up slippage, right? So to that extent, 315 is about 100, 150 a quarter, which has been the traditional run rate for, I think, 3-4 years.
Okay.
I must remind ourselves that the number you see as 1,068 and add the first quarter we took UAE exchange is 175 crores. So that's about 1,250 crores in 3 quarters. That's about 400 crores a quarter, and which has been the slippage per annum. About 1,600 crores has been slippage for much better years. So in a worse year, if we come to a number even better, I think it's a remarkable tribute. Of course, there's a 1,500 crore restructuring on which you can assume any assumption of slippage. The number doesn't stack up to being very adverse.
Okay, just one last question if I could ask, sir.
Please.
So just on this, on the business growth, balance sheet growth side, credit growth is on an average, we have around 6.5% number. So what is driving the fee income number this quarter?
Across businesses, the cross-sell opportunity, the gold loan origination has a significant component which is processing fees. All our retail products, Harsh pointed out some very good successes on the corporate side on fee income generation. Wherever we are not able to get income on the credit side, we are pushing those customers for fee income opportunities. So it's a bunch of stuff. The whole bank is coming to work to square off reduction in credit growth to other fee income opportunities.
Okay, thanks, sir. Thanks and all the best.
Thank you.
Thank you. The next question is from the line of MB Mahesh from Kotak Securities. Please go ahead.
Good afternoon. Shyam, the first question is on the SMA book. If you could just give us a color on where are you on that particular portfolio as compared to where you were pre-COVID, to understand if you are in a position right now to forecast slippages for the near term.
When you see SME, let me add up commercial banking and business banking so that the theme gets better. 25,000 crores is the outstandings. You've seen the restructuring.
SMA book, Shyam. The SMA book, the SMA 0, 1 and 2.
Oh, SMA book? Interestingly, actually, it's looking, the SMA 1, 2 is about 70 basis points higher than our pre-COVID. Pre-COVID, we were close to 1.8 or so. Now we are about 2.5, 2.6.
So is it fair to assume that you have reached now in a position where you can start forecasting slippages with lot more accuracy getting into Tokyo and next year? Or you think it's still
I think, Mahesh, we'll be in a better position to see after the sort of the Supreme Court's decision is, sort of clear and final. We have certain estimates, which is why we have a little more sanguine view on our 22 and 23 outlook. But let's see one more quarter of real payments and, real post standstill clause being lifted kind of payment. But looks reasonably okay, given that the SMA 1 and 2 for this segment looks quite encouraging.
And the restructured loan book that you're seeing, about 1,500 crores, have most of it fallen from the moratorium book?
Babu, would you be able to answer that? Babu?
Am I audible?
Yes.
Yeah. So let me clarify. The 1,500 number that we are discussing is for the entire financial year that we are discussing. So we didn't do 1,500 restructuring so far. Only little less than half of it is only the bank has so far did. And our guidance for the financial year is that we may reach somewhere around 1,400, 1,500. Just to clarify that position I'm discussing. So that's point number one. And secondly, on the restructuring side, I just want to get what is that additional clarity that is secured on the restructuring book.
How much is coming from the moratorium book and the non-moratorium book?
Actually, answer is the major. More than 90% is coming from the moratorium book only.
Yeah, from the non-moratorium book, it is only 0.02%.
Okay, sorry, just one clarification on this. The moratorium that you have reported to us and the moratorium which you have reported to RBI is one and the same. Okay?
Photocopy. We are the only bank which you can confidently say what we showed you and what we showed RBI is the same. Okay. Absolutely to the dot.
Okay, just one last
Overall, I'm Babu here again, and overall it is only 0.5% of the book.
Yeah, okay, that's okay. Just one clarification on staff expenses. We continue to see these very high provisions on retirement expenses. Is there any way that we can have a handle on how to forecast these numbers?
No, Mahesh, can't. Because we report what we see, we don't smooth it. And unfortunately, we will go up or down, it swings. And the second, this time it was pronounced because the gratuity impact after the wage negotiation was done was a one-off impact which will show through in Q3 and Q4 because the basic salary got readjusted and gratuity goes up when the basic salary goes up. So in Q3 and Q4 we will have to take the hit and then move on. So to that extent, these 2 quarters will be about 30 crores extra on staff expenses.
Okay, perfect. Thanks a lot.
Thank you. The next question is from the line of Vivek Ramakrishnan from DSP Mutual Fund. Please go ahead.
Good afternoon and congratulations. I had a question on net interest margins. Your cost of deposits has dropped quite continuously, and it's now it dropped by 23 basis last quarter also. And given the fact that like high yielding businesses like mortgages, CVs and microfinance are yet to pick up, could you see that there's more room for pickup in margins going forward in terms of a sustainable level, especially given the fact that your product mix has also changed favorably to retail, where the pricing power is usually high in most products?
Correct. We had mentioned when we were at about 3.04, it was a sort of inflection. We were pushing for higher. At that time, we had guided 315 to 320. We are in that space now. I think the next 2 quarters also this may continue around this. As we get our cards, microfinance and commercial vehicle business up in a little more sustainable manner, I can give some more better guidance for the future. But for the immediate future, I think in this range where we are operating now plus minus is where it will be.
Okay, sir. Thank you very much. That was my only question. Thank you.
Thank you.
Thank you. The next question is from the line of Amit Kumar Premchandani from UTI Mutual Fund. Please go ahead.
Thanks for the opportunity, sir. I just had the question on the pro forma slippage. The number that you had mentioned, 1068, how much of that was in Q2 and what percentage or what amount was in Q3? And another related question is, you had created provisions on account of COVID. What is the outstanding number as of now, and how much of it has been utilized this quarter? Thank you.
I think it's there, but anyway, let me clarify for you. We used 51 crores from the 587 crores, so the residual is about 532 crores. The 51 crores has been used for the restructuring standard, for the restructuring account. As you see, the restructuring for the quarter is about 600 something, so we've used 51 crores for that. The pro forma slippage is 1068 for Q2 and Q3. Q2 was 234. You can't directly do 1-to-1, but 234. So you can say that this quarter is about 800. Out of that, 205 is the ILFS intra account, which is, I think we've explained it there. So 600 odd crores is this quarter's unique slippages, for which we made the provisions as though it was NPA.
Sure. And you have not created any fresh COVID-related provision this quarter?
No fresh provision. Credit provisions we've increased by 390 crores.
Despite having no actual slippage or very minor actual slippage?
22 crores was the slippage. We've added credit provision of 390 crores and we reversed the interest income for this entire slippage.
398 crore credit provision were for basically existing slippage rather than the pro forma slippage?
Which is for the pro forma slippage. I mean, as in the assumption is if this were a slip, what we would have provided.
Right. And how much was the interest reversal, sir?
Cumulatively 73 crores.
So the interest component of the pro forma slippage has been taken care of completely?
Yes, sir. Across 2 quarters, the 1068, 73 crores has been reversed out. And on the corporate account, there is interest frozen from June 21. So June 20, so there's no interest recognition.
That account, 205 crores on that account, from June itself, there is no accretion of interest.
Yes, sir.
There's no need for any reversal there.
In terms of the corporate segment, restructuring number seems to be pretty low, not with respect to expectation, but even on an absolute basis, do you think this will sustain even going forward?
Yeah. We think another 150 crores may come, which is built into the 1,500-1,600 crore number that has been put out in slide number 8.
And 859 crore retail, you are saying almost a large part of it is mortgage, right?
Between mortgage and LAP, yes. Secure portfolio.
55-45, largely that is the...
Plus minus. Don't hold me to the last digit, but yes, that's the one.
Sure, sir. Okay, sir. Thank you. That's it from me.
Welcome.
Thank you. The next question is from the line of Nitin Agarwal from Motilal Oswal. Please go ahead.
Yeah, hi, good afternoon, everyone. Congratulations on strong results. Few questions. Firstly, what is the total quantum of restructuring requests that you have received? Like now we are looking at 15 to 16 billion worth of restructuring versus 35 billion earlier. So can we say that the difference of say 20 billion worth of loans are now behaving absolutely fine and no longer therefore need to be kept under watch?
Actually, the request was not 3,300 crores. The request assumption was it can be that. Request would have been 1,800 crores or less.
Okay, so sir, like earlier, whatever the number 36 billion that you were estimating that request number to be, so now that number has come 2,000 crore less than that number. So
yes.
Is that 2,000 crore worth of loans like behaving absolutely fine, or you think that we should still keep it under watch?
No, I mean they are behaving quite well, but everything needs to keep a watch, right? In our business, can we take our eyes off anything?
No, either they are behaving fine or they have slipped and they are into a pro forma NPA.
Okay. And how do we read this collection efficiency being flat on a sequential basis? And how much would it have been but for the, say, pro forma slippages and the restructuring that we have done?
Yes, Babu or Ashutosh?
What's that? Please come again.
So our collection efficiency number at 95% is flat on a sequential basis.
Yes.
So how do we really read this number? And how much would this number have been but for the pro forma slippages and the restructurings that we are doing?
Shall I? Babu here. Shall I?
Please go ahead.
Yeah. So on this for this working on collection efficiency, the entire lot of pro forma NPA is kept apart. So we are not considering this pro forma NPA. We have considered the book less than pro forma NPA, and the collection efficiency is reached 95% in Q3. That was the same number in Q3 last year, and that was the same number in September this financial year. So in that way, collection efficiency worked consistently, and then on the same metrics. So there is no pro forma NPA component in the collection efficiency that way. It is separately kept. So collection efficiency remains consistent and constant, 95%, despite all the challenges, even in Q3.
Okay. And the other question is on the loan processing fee, like that has been quite strong versus the growth in the loan book. And you have alluded that we got some fee income opportunities on the corporate banking side, which supported this sort of growth. So how sustainable is this sort of growth, and what are we looking at in terms of this processing fee growth over the coming years? And related to it, what is the sense on the overall loan growth now and the retail wholesale mix that we are looking at?
Many questions. Credit growth for the year we believe will be between 8 and 10%. 10 if environment dramatically picks up. 8 closer to 8 where we will, which means Q4 should see for the quarter reasonable growth across businesses, which we think we are tracking to. The fee income growth, processing fees is very strong because all our retail products we have introduced very good processing fees. Gold doing so well is continuing, so that's sustained. There's no one-off in our processing fees. No sizable one-off, one-off or advance booking or pre-booking the income. So it's a sustained regular growth. And the mix we've mentioned at the beginning of the year that over a 2-year period we'd like retail 55, wholesale 45. I think we are tracking that. And retail here, 5 crore and below, and wholesale, 5 crore and above.
Sure. And lastly, just one clarification. You mentioned that the interest reversal has been, say, 73 odd crores on account of pro forma slippages. So now our NII growth has already been very strong. So if we were to include this reversal, which is like attributable to 2 quarters, then this NII growth works up to around say 30%, 31% YOY growth on a 6% loan growth. So am I reading this right?
You are, but don't put the 73 crores and 6% because that is really gone, right? That's technically not ours. If the accounts turn NPA, then the reversal happens. So in our sense, 24% is a good number. And the mix of the business and the margin expansion and the reduction in cost of deposits and the lower slippages is keeping it going.
Okay, sure, sir. Thank you and wish you all the best.
Thank you so much.
Thank you. Before we take the next question, I'd like to remind all participants, please limit your question to 2 per participant. You may come back in the question queue if you have a follow-up. The next question is from the line of Pranav Tendulkar from Rare Enterprises. Please go ahead.
Hi, thanks a lot for the opportunity. Sir, can you just elaborate that the employee expenses that you have, which has reached a new level, are there any big expenses that you are doing in the future capability building like card or any other business? Because this seems, even if you adjust for gratuity, it is way higher than other regional banks like say Karur Vysya or CUBK, who also have 95% to 100% employees unionized, and percentage difference is something like 40-50% above. So they are like at 8-9 lakhs per employee, and you are at above 14 to 15. So can you just elaborate a little bit more, and how should we project this? Is it going to result in a productivity, or is it going to be a slow superannuation that will rationalize this?
Yeah, I think Pranav, on many calls we've said only by 2023-24 this will start moderating, because the retirements will be at the peak, and after that it will trend, because from April 1, 2010 everybody is on the new pension scheme. So this is all in the defined benefit category. So this will take time to play through, and I believe by that period. But that said, there are 2 components. This quarter and the next, I said, is a gratuity increase that has to be factored in. And otherwise, the usually impact is really yields driven. As yields drop, then you're buying gratuity and your pensioning increases. But that should hopefully, for the coming quarters, if interest rates hold, like between Q2 and Q3, interest rates were yields were pretty consistent, so we didn't see much requirement to increase pension, but this time the gratuity came in. So I do think between Q3, Q4, that impact will play through. After that, it hopefully will stay where they are. The incremental should be very modest.
Right. So we should rationalize this expense by 30 crores minimum by say Q1, and then if yields move up, then actually there will be a reduction because pension liability will reduce. Is that right?
Yeah, you're right. Can reduce slightly. But remember, if pension liability goes down, your treasury income opportunity also comes down.
Correct.
But usually 3x of the spend, so the upside is better than the low side.
That's right, sir. So also a quarter back we had discussed about loss given default in the restructuring book being very low, and now that you have elaborated that this is a housing, so there is a lot of housing loans in this restructure. That means that loss given default will be much lower than the previous cycle. Is that right?
We think we at least our early estimation is as follows. We've done a valuation of our entire home loan portfolio, which is largely backed by property, and we have stressed it by even if property prices were to fall by 35%, which means we see a worsening by 1/3 of our existing loss given default. So from 45%, if it becomes 1/3 worse, it can go to 55% or so. That's why we have taken 10% higher than our worst assumption of loss given default. That's how it came to about steady state of 65-66%.
Right, sir. Right. So also your fee income is now actually going in a very healthy manner. So could you just highlight if card income is having what is the proportion in like credit card and others, and what it could look like say 1 year down the line?
No, credit cards we don't have yet. Once we launch, that will kick in. But our debit card spends, I think Shalini may want to expand on it. She will. Our debit card spends, now we are a absolute top player in the private sector industry, way above our share of deposits, way above our share of cards. There are only 4 banks higher than us, ICICI, Axis, HDFC and Kotak. And we are clocking about 1,000 crores plus debit card spends a month. So that's one fee income opportunity, in addition to all the other loan fee and corporate fee originations that is happening. And mutual fund and insurance related activities are also beginning to catch steam. Shalini, do you want to expand on it, Shalini? If you're there, Shalini?
Yeah, thanks, Shyam. So I think just taking off from where Shyam left it on the debit card piece, as Shyam mentioned, we are clocking about 1,000 crores in the month of December and clocking higher January, February, March from what you can see as the run rate. This is notwithstanding the fact that all of us know a couple of segments have literally disappeared from the debit card markets kind of categories like travel, hotels, hospitalities, considerably lower when compared to pre-COVID times. And notwithstanding the fact that, we've all introduced card controls of the kind like you switch off your card and you need to switch it off when you're not using it, etc. So I think this has come out on the back of the fact that, we were one of the first to launch the contactless cards. We repositioned our entire debit card proposition. We now have a proposition for our high net worth segment called Celesta, for our mid-market called Imperio. We have got something else for the general kind of customers, which is Crown. So we've got different card propositions for different segments. And we've got partnerships and tie-ups with virtually everybody you can think of, from the Amazons, the Swiggies, and the Flipkarts of the world. So yes, the debit card spends is a good story. It's translating from a fee income standpoint. You'll see the details in the presentation that's been circulated, but it's also resulting in sticky savings account balances, which is also evident from the fact that our SB growth has been pretty good this quarter and this year. So yes, we will continue to focus on this piece in debit cards, and in due course, credit cards will obviously be a contributor to the fee income as well as the interest income line.
Right. Thanks a lot for the opportunity, and congratulations for holding through the crisis.
Thank you.
Thank you. The next question is from the line of Manish Shukla from Citigroup. Please go ahead.
At one point of time, you mentioned that SMA 1 and 2 is about 2.5%. Is the restructuring book part of this, or restructuring will be on top of it?
Babu?
Yeah, so this the SMA number that we discussed is in that book there is no restructuring.
Okay, so whatever the 0.5 is on top of it. Fine.
Yes.
Second is on net interest margin. I think you've done a very good job on your liability franchise despite lowering of rates. Your deposit growth is strong. You've already taken charge on interest reversals. I'm just curious, why are you not more, let's say, optimistic on margin expansion from where we are, given the liquidity that you're carrying on the balance sheet?
We are a little more conservative about our commitments. We will work to a higher number, but I think at this point in time, I'll keep the guidance around this.
Okay. Lastly, sorry to repeat, but maybe Harsh, if you could expand on the corporate fees, right? So for the 9 months this year, you are already at about 80% of full year 20 in terms of fees on a much lower balance sheet. So A, what is driving it, and this disconnect between balance sheet growth and fees, can it sustain into the future as well when it comes to corporate fees specifically?
Yeah, Harsh here. We have been in February also, we had guided that what we are looking at is a higher NII compared to asset growth and a higher fee income growth over NII. This is what we had been doing. There are two parts to it. One is obviously your PF related, which we have been asking and getting much more from the existing clients, and plus onboarding new ones. The second aspect means that we are deepening our relationship with more trade products, more treasury, and more transaction banking products. In fact, in our digital offerings also, we have increased our presence. So all these things are driving in terms of getting a higher fee income, which is also creating stickiness with our existing customers. So this is something which we expect to continue.
Please expand on Fed EBIS and the successes you had with Equinus also.
Yeah. Okay, a couple of other things also which I would like to elaborate on. We did, last time I had mentioned about an online commercial paper issuance, which only very few banks have done that. Apart from us, 3 other banks I think have done it. And we have done it digitally online along with NSDL for 4 of our customers. That's one part. Secondly, we are talking about artificially intelligence powered invoice reconciliation for B2B collections for corporates. This is again one of its kinds, which we have launched for one customer, and we are expanding it on that. So there are a lot of products which is being bought in on the digital side, which is getting us more collections and payments and hence fees as well, and float. On the Equinus side, our relationship has expanded, and we are working with them fairly closely in terms of BTI mandates, which again is giving us a float income. So these are the areas where we have been focusing on. So with the same corporates also, the deepening and penetration has increased significantly, and we expect that to only increase going forward and improve. Is there anything specific more you would like me to highlight? But this is broadly what our strategy has been.
No, sir. This is good for now. Thank you. Those were my questions.
Thank you. The next question is from the line of Renish Patel from ICICI Securities. Please go ahead.
Yeah, hi sir. Congrats on a great set of numbers. Sir, just a couple of questions. So one is on this collection efficiency again. So at 95%, we are already at the pre-COVID level. So from let's say September to December, what sort of customer behavior we have seen? I mean, in between, there are customers who might have paid and then again in December they might have not paid, or maybe we have seen the same customers paying all through this month. So how to reach this collection number?
Babu?
Yeah. On the customer behavior.
Patel, I'm so sorry to interrupt.
Renish has to mute. Renish has to mute.
Yes.
Your line is bad.
Yeah, sure.
Yeah, on the collections customer behavior side, as it was discussed in this call, maybe on the restructuring book, there were some customers who were asking for restructuring, and some customers who were maybe because of this pandemic and COVID situation, some customers were getting low paid, or some customers just lost a job. These are the situations. So those customers found some difficulty to meet their repayment obligations. But some of these customers, they continue to meet the EMI. And then some of these customers is opted for restructuring, which based on their eligibility was also given. So when we discuss generally what was the customer pattern, this was the customer pattern. There was no such additional, maybe no customer behavior or specific customer behavior, maybe no different from the market situation. At the same time, what we found the difference in the collection efficiency in Q3, that's a very, very, very positive signal. In Q2, when we said 95% collection efficiency, there was no demand from the moratorium book. Demand was only from non-moratorium book. Non-moratorium book repayment in September, it was 99% collection efficiency. So that, and then contributed by other factors, we could repay 95% even though there was no demand from the non-moratorium rescheduled book. But in Q3, really there was demand from the this moratorium rescheduled book also. So despite that demand, entire loan book there was demand and collection. And with that demand as a collection, we could reach 95%. Means positively we could find that people started paying promptly, but for the account which we restructured and that we performance here that we are discussing. So 95% of September and 95% of December is not equal in that day, but 95% of December 19 and 95% of December 20 is almost equal. So in that way, collection efficiency improved. There is no major notable customer change in the behavior, repayment patterns, but for the reason that I discussed.
Got it, sir. So basically, Q3 collections are broad-based, reflecting the entire quality of our book instead of Q2, where most of our customers might be in their moratorium.
Yes.
Just to add, I think the best part is if you have more of restructuring coming from mortgage loans, whether LAP or housing, the loss given default is minimal there because you have a solid underlying security to back that. Whereas the value of the security in case of other segments may not be that recoverable or so. When it comes to recovery process and all. That's one part.
Got it. Yeah. That's it from me.
Thank you. The next question is from the line of Simranjeet Singh Bhatia from SMC Global. Please go ahead.
Thank you for giving me the opportunity. First of all, congratulations to all the Federal Bank team for the fantabulous Q3 numbers. And sir, Shyam sir, are you there? Hello.
Very much. Yes.
Hello.
Yes, I'm there very much.
Yes. Why is this not clear? Hello.
Yeah, please go ahead.
Yes, sir. I want to know that can you give some specific target for this NIM percentage of the going forward, because you have posted the best of the best 3.22% in the past 23 quarters. So can you give some guidance on that? And secondly, your CASA is right now at 34.48%. So can you give some guidance on that part also? What will be the percentage, or this 100 will be going to be maintained in the CASA ratio? And thirdly, I want to understand why you are not conducting any sort of road shows for the Federal Bank.
Three things, Simranjit. Thanks. One is on NIM guidance. I think we mentioned 315, 320 in that range. And consequence, CASA right now is 34.4. We think anything between 33.5 and 34 will be the number. As you know, in Q4 there will be some movement in current account because the RBI circular fully goes on stream. We may gain in some cases, we may lose in some cases. So I think between 33.5 to 34, and the NIM consequently between 315, 320. On road shows, so we are, we meet our investor friends and analysts continuously through various platforms, but we haven't actively gone out and done too many things. Before the pandemic, we had a fairly exhaustive session, and as things turn out well, and after we complete financial year 21, we will again come back to the market with a more organized presentation and talk to people. But we are open, and we've been talking to many on a regular basis.
Great, sir. And sir, last question is that can we expect a double-digit advance growth in the Q4? Means because you have guided for 8 to 10%, so that clearly comes to 12% or minimum 10 to 12% advance growth in the Q4 itself.
Yeah. Our pipeline suggests Q4 to be annualized run rate of Q4 to be in the early double digits, which is the number you are talking of. Yeah.
Done. Thank you, sir, and all the best for the future endeavors. Thank you, sir. Thank you.
Thank you so much.
Thank you.
Thank you. The next question is from the line of Roshan Chutki from ICICI Prudential Mutual Fund. Please go ahead.
Yeah, thanks for taking my question, sir. Firstly, just one question basically. What is the tonnage growth in this quarter year-on-year basis? You have a 67% growth in gold loan book, right? So what is the tonnage growth there?
About 47 from 44. I think it's gone up by 3 to 4%. 3 to 4 tons. Mohan, if you're there, or Ashutosh, do you remember? Or
yeah, it is 45 tons.
Yeah.
45 metric tons, yes.
So if it's Roshan's question is, are we just giving to existing customers without growth? No, it's growth.
Actually, in tonnage, the growth is 20% plus 20-22% range, whereas in value terms, it is 67% YOY. So, yes, the price of gold also is, resulted in more customers coming in and sometimes, higher eligibility for the same tonnage vis-a-vis last year.
We track it every week, Roshan.
We track it on a weekly basis, tonnage as well as new acquisition, new accounts, and the value, of course, nominal value.
And how are you doing on the LTV basis here?
72% is portfolio LTV.
Okay. All right. Thank you so much.
Welcome.
Thank you. The next question is from the line of Krishnan ASV from HDFC Securities. Please go ahead.
Yeah, hi Shyam. Very good evening to your entire team. Just wanted to check what kind of productivity gains are sustainable given the kind of digital initiatives that you have taken across, retail, corporate. You're seeing there is a lot of debit card spends that are happening. So just wanted to understand, you must have seen, other than the employee expense, which is a drag which will continue for 3-4 years, is there anything sustainable you see around for productivity gains or efficiency gains? That's number one. I have one more question on your NBFC. The numbers that we see, is there any restructuring in your NBFC book?
No. Very, very marginal. NBFC book is doing very well.
Yeah. The first question was around the productivity gains, efficiency gains, and what part of that may be sustainable according to you?
I think we've invested very materially in everything that can be. If you see our employee headcount for 2 years has been plus minus 100.
Yeah, I guess your branch count also has hardly moved over the last 3-4 years. Yeah. So obviously you're doing a lot more business with the kind of infrastructure you already have in place, and that's very credible. I just wanted to understand, given digital initiatives are something that you have been very proud of, I just wanted to understand how do you quantify ever the effect of the kind of initiatives that you've taken there? Hello.
So there's a lot of disturbance from your audio.
Yeah, Operator, I'm back. Shyam here. I think my line dropped. I don't know when.
So you may please go ahead.
We have somebody has answered.
No, Shyam, I think Krishnan's question hasn't yet been answered. There was a lot of static on the line, so we were all waiting to find out. You're back, right?
So is this better? Is this better, Shalini?
Yes.
And that's better. Shyam, you can pick it up or?
Yeah, I know others can add in, Shalini and Ashutosh and others, but the short point is the improvements in productivity X these one-off vagaries of pension and gratuity has resulted in our overall operating expenses being reasonably under control despite the volume and revenue growth. And if you see our headcount, for about nearly 2 years, we've kept it plus minus in that 100 people range. We haven't added very significantly, and because we are not doing much branch expansion, we are not putting in tons of people other than the retirement or attrition related, and thankfully our attrition levels are sub 2%. So I think the productivity enhancement is significant and will continue, and I think maybe Shalini and others can expand on the.
I may further add on the employee expenses, staff expenses side. I think probably we have seen the bottom of this interest rate cycle. It looks like I think going forward we may have interest rates moving up, and when yields fall, naturally you would have more of treasury profits on the fixed income side. At the same time, you will have on the operating expenses side the impact on the future provisioning for gratuity, pension, etc. So going forward, with the rates move up and all, to that extent, the operating expenses would smoothen. In fact, you will have less of staff expenses happening because this is not something which is being paid immediately right now to the existing staff. It's the provision for future, which is seeing the double-digit rise. So that suggests that in case the interest rates are flat or they move up, then you will not have that in at least coming a couple of years.
Okay, just one last question, if you don't mind, Shyam.
By that time, probably the eligible, defined benefit pension employees, the number would have, in comparison to the total staff strength, would also thin. I mean, would also come down drastically. Every year you have a retirement
because of retirement.
Employees who are having this type of entitlement, defined benefit.
Right. Just one last question, if you don't mind, Shyam. On your own personal stint at Federal Bank, you have generally been shy, letting your actions speak louder than words. But just wanted to understand, given you are one of the very few banks where what you see is what you get, what problem can the RBI have in terms of extending your tenure?
We hope none, Krishnan. Our board will go to RBI 6 months in advance. I have confirmation even today with our board that the renewal process is underway. So well in advance we will. Now, finally, it's RBI's decision. We hope none. No problem, but let's see. Maybe I've been caught in the crossfire when they were changing policy or what. I have no idea, no answer. But other than the fact that well in advance, our board will go to RBI and place the requirement for renewal. Well in advance.
Okay, I'm done. Many thanks. Thank you.
Thank you.
Thank you. The next question is from the line of Pankaj Agarwal from Ambit Capital. Please go ahead.
Yeah, hello, sir.
Hi, Pankaj.
Am I audible, sir?
Yes.
So the CASA growth we have seen over the last 9 to 12 months, is it broad-based or is it coming from some specific segments of,
Very broad-based, Pankaj. I think I mentioned in the last call, and I'm happier to mention this call even better. The entire franchise, erstwhile, many years back, it was largely driven by our Kerala network giving us the bulk of the deposit growth and the ratio of CASA. Happily for us, the rest of the franchise is now tracking at, by itself, if I ran it as a bank, their CASA would be well close to 32%.
But what explains this CASA growth for the entire banking system over the last 9 months? Like across the banks, we have seen a very sharp rise in CASA growth. So is it just a temporary blip and we can see reversal in this trend going forward? Or do you think this CASA ratio can sustain not only for you but for the entire banking system?
I think there will be some remedy, some changes as spending increases. See, there is a certain degree of lazy cash lying in the accounts of every customer, including you and me. So your spending avenues have reduced and probably your digital spending has gone up. So your cash withdrawals from ATMs and your cash loose change lying at home all come down. That may reverse if the economy picks up and more traction happens. But so I think it's a function of that. Let's see how it goes out.
Thank you, sir. That's from my side. Thank you.
Thank you. The next question is from the line of Jay Mundra from B&K Securities. Please go ahead.
Yeah, hi, good evening, sir. Just two questions. First is, sir, if you can quantify the FITL amount that you may have given, I mean the account which would have taken FITL amount.
Hitosh or Babu or anybody, would you have the number? Or Kapil?
Sorry, please come again.
FITL. Kapil?
FITL number?
Yeah.
Hi, this is Kapil here.
Available. Babu, do you have?
Yeah, I don't have that number right now, sir.
Kapil would have for commercial banking.
I will have for commercial banking only. I don't have for the entire bank.
Okay, what is commercial banking? You can share that. We can extrapolate from there.
If you impact FITL amount which we have given?
Yeah.
54 crore is the FITL amount.
Yeah. So bank would be about 150, 200 crores maximum.
All right, sir. And second question is, sir, on your ROA tree. So just if I were to look at ROA tree, your margins are in place, and OPEX also as a percentage of assets is also around 2%, which is is also comparable. The fee income, which is slightly lagging, and despite we have seen reasonably good performance in this quarter, but still it is around 60-70 basis point odd. While we can see a lot of initiatives on digital merchant fee and probably credit card also. But from 12 months or 18 months perspective, how do you see this fee to asset ratio moving, sir? Yeah, thanks.
We are tracking to getting it closer to 1.2. We are at about 1% or 1.03% right now. We have all the initiatives in place to take it closer there.
Right. Okay. Sure, sir. And this credit card launch, is it
Total assets are 1,90,000 crores nearly, and I think fee annualized would be in excess of 1,900 crores. So I think we are already at 102, 103 basis points, closer to 103. And I think going forward, I think it can move to 110 basis points.
Actually, I was removing treasury, but anyway. So
that's okay. And take for 5 years average, and you can see that for treasury. It's not a 1 year story. Treasury also every year the number is more or less tracking. For the year as a whole, may not be for a quarter specifically, but year as a whole, it's almost same.
Sure, sir. And this credit card, is it going to be a big bang launch, or would be some co-branded exercise, or it would be some pilot, or you have already done and then it would be standalone Federal Bank, big bank.
Standalone Federal Bank card launch for the first few months, or maybe a year, we will do for existing customers on a cross-sell and an invite basis, open to new categories over a period of time. We will season the portfolio. First 2 months will be to run it on our staff, ensure everything is going well, and then we'll open it to existing customers and then build the portfolio from there. We have a customer base of 80 lakhs and a cross-sell base that is emerging from that.
Right. Thank you, sir.
Thank you. Well, ladies and gentlemen, we'll take the last 2 questions for today. Next question is from the line of Kaushik Poddar from KB Capital Markets. Please go ahead.
Hello. Shyam, your exposure to banking to NBFC and HFC is around 11% of the advance. How healthy are these 2 sectors?
Doing very well, Kaushik. It's all, I've always said in all our calls, it's in the blue chip of that portfolio. Looking good, and we are happy with that portfolio.
Are you decreasing your exposure to these 2 sectors?
Actually, in the names we lend, they are decreasing their borrowing. I would love to lend more to some of these names.
But as a percentage of the book, it's come down, Shyam.
Yeah, that's what I'm saying. I would love to lend more to these names, but they are not borrowing enough.
Okay. And your exposure to real estate, where does it stand?
We don't have any direct exposure to real estate.
No, but in the slide you have shown on 1.2% or 1.4% something.
LRD. Lease rental discounting, which is coming under that. If your agreement is for a period, lease agreement is for a period less than the tenure of the loan, then it is to be classified as commercial real estate, CRE.
Okay, you're not lending directly to them.
No, we are not lending to construct. I mean, there is no construction finance in our book.
Okay. Thank you.
Thank you. The last question is from the line of Manjeet Puria from Solidarity Investment Managers. Please go ahead.
Hi, good evening, and thanks for taking my question. I just wanted to understand the gold loan, lending market a bit better. When we lend to customers, are these the customers whom, would also consider a gold loan NBFC? Or, they are a very different set of customers because the, rates you may charge and, what the gold loan NBFC charge are quite different. So just wanting to get a sense around that.
I think these are not terribly mutually exclusive, but largely a customer who comes to the bank is not somebody who sort of normally goes to a NBFC, but I can't say they're like completely compartmentalized, but I would say a significant share is existing customers and customers of the bank who are unlikely to go NBFC at the outset.
Right. So if I also flip it around, the rates which banks would possibly offer, these gold loans will be much more competitive than these gold loan NBFCs. So what prevents those customers to come to banks, with, lot of communication behind what the rates are? Is it that they are not comfortable with, stepping into a branch?
No, that we are growing at this rapid pace when the giant NBFCs are growing at such a small rate, it suggests that a significant migration is happening to banks.
So the customer possibly, the reason can be the customers are not really comfortable walking into a bank branch or anything on those lines, basically.
Theory, I don't fully agree at this juncture. It used to be, but I think that sort of stigma of borrowing against gold has long gone. I'm not saying it's entirely disappeared. And second, even in banks, we are doing reach out, right? I mean, I have our own fintech partner who does the gold at your place, at your will, at your time. So that embarrassment is also vastly reduced.
This is very helpful. Thank you.
Can we bring this to a close?
Sure, sir. Well, ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Shyam Srinivasan for closing comments. Over to you, sir.
Yeah, thank you, everybody. I do think you have a good gist of how we've performed and what we are looking at and how we are tracking. And Anand and team will be happy to give you further clarification if you want. And all the best, everybody. Thank you very much.